This class is Financial Management. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I currently work as a chief economist and adjunct professor of accounting and financial management. In today's lecture, we will cover Chapter 8 on Basic Stock Evaluation by the excellent text Brigham and Davis. We will first discuss basic features of common stock, then we will go through how to value common stock, including the dividend discount or growth model and the free cash flow valuation model, and also using market multipliers such as price to earnings ratio, book to market value, etc. And then we will discuss preferred stock, which is really a form of subordinated debt. If we look at the corporate valuation of a company, the value of operations can be valued as the discounted sum of free cash flows, discounting by the working average cost of capital, the calculation of which we will discuss in a later chapter. Also, you could value stocks using the dividend discount model, which is the discounted sum of all future dividends by 1 plus the cost of equity or the required rate of return on equity, which can be calculated with things like the capital asset pricing model. So what is common stock? In principle, the common stockholders own a company. Ownership implies control, and the stockholders should be able to elect the board of directors. In practice, this might be the case for a closely held company. For a company where nobody has a large fraction of stock ownership, stockholders may have very little influence on the board of directors, particularly in companies that are largely controlled by index funds. But the directors, however they get elected, maybe the CEO just proposes them and they get approved, they hire the management, and managements are agents in principle of stockholders, so their goal should at least be to maximize the stock price for stockholders. Since many of them do have things like incentive stock options and get call options on the company's stock, at least this alignment of the interest of the management with the stockholders is commonly true. There are several different types of stock. Classified stock has special provisions. You could classify existing stock as founders' shares with voting rights but dividend restrictions. One of the famous examples of founders' shares is Peter Thiel putting his PayPal in a Roth account so he could become a billionaire without having to pay taxes, which was a very smart move. Other types of classified stock could be new shares, might be called Class A shares with voting restrictions but full dividend rights. Not all stock controls a company. There can be things like a tracking stock, where the dividends of tracking stock are tied to a particular division rather than the company as a whole. Investors can then separately value the divisions, and it's easier to compensate division managers with tracking stock. This could particularly be useful in very large conglomerate companies. An example of tracking stock in the past was when Barnes & Noble created a small tracking component for their online division to sort of make it look like it was competing with something like Amazon. But tracking stock usually has no voting rights, and the financial disclosures for the division is not as regulated as for the company. There are different approaches for valuing common stock. We will discuss the free cash flow model. We will discuss the very simple model with constant growth and then more generalized to non-constant growth. We will also look at the dividend discount or growth model, both in the constant growth simple form and the non-constant growth more complex form. And we will also use various multiples to compare firms. The free cash flow valuation model will be set up first by calculating free cash flows. And the free cash flow available for distributions to all of the company's investors generated by a company's operations, and you will discount that by the weighted average cost of capital, or WACC, which is the overall rate of return required by all of the company's investors. We will go into more details on how to calculate WACC in the next chapter. So the value of operations is the discounted sum of all future free cash flows from now to infinity. We have to somehow guess what these will be from now to infinity. And of course, very few companies last more than 100 years. The general approach is you estimate the free cash flows for a few years, and then you estimate a constant growth after that. So sources of value for a company, well, value of operations, which is what you will use the free cash flow model to calculate. But companies also typically have non-operating assets. They have short-term investments and other marketable securities. They might have ownership of non-controlling interest in another company. And the value of the non-operating assets usually is very close to figure that is reported on balance sheets. So generally the book value is the same, or close to the market value. Claims on corporate value, which are particularly important in the case of a bankruptcy, well, debt holders generally have the first claim, although in strange cases like the General Motors pre-packaged bankruptcy, that didn't turn out to be the case, and instead the first claim basically went to the labor unions. After that, preferred stockholders have the next claim, and whatever's left over, the residual value, any remaining value, belongs to the stockholders. And here is a graph of the way a company would be valued. We have the green on the left, the value of operations, and that generally is going to be most of the company, and then marketable securities would be slightly separate from that. And the ownership of all this is controlled by a combination of equity, debt, and preferred stockholders. Equity might be a large fraction as shown, or it could only be like 10% of the assets, like in a bank, which is very heavily leveraged. So the value of the operations portion, again, is the present value of future cash flows discounted at WACC out to infinity, as shown in this equation. If the free cash flows are expected to grow at a constant rate, say G sub L, G long term, starting at 1 and continue forever, well, what happens to free cash flow? Well, free cash flow 2 will just be free cash flow 1 times 1 plus the growth rate. 3 will be for free cash flow 1 times 1 plus the growth rate squared. So we can generalize this and see free cash flow at time t is free cash flow at time 1 times 1 plus the growth rate to the t minus 1. And we can sum this geometric series to figure out what the value of the company is. The value of the operations portion of the company is therefore VOP equals the discounted sum of all future free cash flows by the working average cost of capital. Our free cash flow 1 over 1 plus WACC, free cash flow 2, which is free cash flow 1 times 1 plus the long-term growth rate over 1 plus WACC squared, etc. For convenience, to show how a geometric series works, we will multiply and divide by 1 plus the growth rate. As shown here, and then we will group the free cash flow 1 over 1 plus the growth rate, and show the equation here. Now we have value of operations is free cash flow 1 over 1 plus the growth rate. We can pull that out, and then we have 1 plus the growth rate over 1 plus WACC, first to the first power, then squared, then cubed, etc. And this is a geometric series. As long as the growth rate is less than WACC, then this will converge to a constant that we can calculate and use. So what happens as 1 plus the long-term constant growth rate over 1 plus WACC as t gets large? Well, again, if the growth rate is less than WACC, then 1 plus growth over 1 plus WACC is less than 1, and this series will converge. On the other hand, if the growth rate were greater than WACC, then this series will not converge and instead goes to infinity. So first we look at the value of operations if the long-term growth rate is greater than WACC. Then, for example, we would have a 2 here, a 4 here, and 3 4s here, 4 4s there, bigger, 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 and going to infinity. This does not converge. So this cannot be used for the constant growth stock model. But if the long-term constant growth rate is less than WACC, then our term here, 1 plus the growth rate over 1 plus WACC, is less than 1. For example, 1/2, 1/4, etc. Each term gets smaller, and then you get the convergence of a geometric series. In the example here, they show what is the sum of an infinite number of factors that get smaller and smaller at a geometric rate. Well, let's say if t equals 1, 2, 3, 4, 5, etc., and each of these terms is 1/2, then the first term is 1/2. 1/2 times 1/2 is 1/4. 1/2 times 1/2 times 1/2 is 1/8, times 1/2 again is 1/16, and this basically goes to 0. You can start summing these terms up, and we have 1/2 plus 1/4 is 3/4, plus 1/8 is 7/8, plus 1/16 is 15/16, and that converges close to 1. Similarly, the value of operations through calculus calculations of geometric series can be shown to converge, but not to 1. What they converge to is the equation shown here. The value of the operations at time t equals 0 is the free cash flow in year 1 over WACC minus the long-term constant growth rate. Commonly, you will know today's free cash flow, and then you will be projecting into the future, the end of this year, the beginning of next year. So we will rewrite this operation as the value of operations is free cash flow 1 plus the growth rate over WACC minus the growth rate. As an example, consider a company with free cash flow 0 of 24 million, a WACC of 11%, and the free cash flow is expected to grow at a constant rate of 5% per ever. They currently have some short-term securities of $100 million, and they owe $200 million. They also have preferred stock of 50 million, and the number of common stock shares outstanding is 10 million. Let's find the value of operations. Well, the value of operations is going to be the free cash flow in year 0 of 24 million times 1 plus the 5% long-term growth rate, or 1.05, over WACC minus the long-term growth rate, or 0.11, minus 0.05, which is 0.06. And this gives us the value of operations is $420 million. The total value of the company is the value of operations we just calculated, plus the short-term investments of $100 million, which gives us a total value for the company of $520 million. If we want to get the estimated intrinsic value of equity, well, we have this total value of the company of $520 million. We subtract out the value of debt of $200 million and the value of preferred stock of $50 million. So the value of equity of the company is $270 million. And if we divide that by the number of shares outstanding, which is 10 million, we get an estimated intrinsic value, our stock price, of $27. We will continue this lecture in part 2. I thank you for for watching this video.